4,000, 5,000 zone for gold is not some overdone level. It's only half as much as the prior two bull markets. And during that same time, and I think by summer probably, silver will be in the $300 to $500 range. Even JP Morgan recently came out with the ultimate target of 9,200 or something. It's done it twice before under far less driven conditions. So yes, their energy costs are going up, but not in relation to offsetting their profits per ounce of gold or silver. The central bank panics and print more. The problem is it never works. Once those bubbles start to break, it says, that's it, through, I'm going down, I'm going to flush myself. And that money goes elsewhere, always goes into gold. Will their move be over by summer? Rapid gain, especially in silver, will be accomplished by then. And when this stock market breaks, that's going to cause the central banks to panic. The Fed has a real problem. They got their own bond market that's ill, and they got a consumer credit problem. They're going to print. Gold smiles. They destroy paper money, gold goes up. You got to watch those other markets because they are the drivers.
If stocks do go down, would you say that initially that could pull gold and silver with it as well and potentially create another buying opportunity?
I think you just saw a coincident sell-off in all those categories, which is rare to see all like gold, silver, stock market, and T-bonds. Because remember the old balanced portfolio false notion, I think Morgan Stanley, chief investment officer, altered it several months ago. That's 60% stocks, 40% bonds. Bonds being a, quote, safe alternative. Well, they're not acting like an alternative anymore. The only thing that's been acting like an alternative when you measure year to year, or even just the first quarter of this year, is gold and silver. In fact, we ran a graph to just make the point to people that despite the collapse in silver and gold that we saw in one very bad day at the end of January, most of it was then. Silver and gold and the silver and gold miners were up 7 to 8% in the first quarter versus where they closed 2025. S&P was down that much. So the graphs were totally up, one down. So despite the fact they seemed to move together, they were actually, from an investment point of view, oh, I made 7, 8% in the monetary metals. Despite, if I bought it December 31st last year, and if I bought the stock market, I'm down that much. So they were opposites.
What looks like a synchronized sell-off is actually exposing a deeper fracture in portfolio theory. As Michael Oliver points out here, the classic 60-40 model is quietly failing, with bonds no longer acting as a shock absorber while gold and silver step into that role. A 7 to 8% gain in metals versus an equivalent S&P decline in Q1 is not noise. It signals a rotation in capital behavior. Institutions won't admit it yet, but diversification assumptions, built over decades, are breaking under inflation and rate pressure. Next, Michael Oliver discusses how macro data will force central banks into reactive mode.
Anyway, I think that's where we're headed. I don't think there's a crash event, though. And I think the major event is the economic data points that go south with the stock market. Because usually those data points that everybody's focused on, unemployment, factory output, all these various and sundry things that the Fed likes to, mandate. So usually come after the stock market has rolled over meaningfully, and then suddenly everything goes dark. And that's when the Fed has excuse to fully panic.
Right, that's very true. So you have mentioned, Michael, silver targets for the summer 25 or 26. What would be the gold target?
I don't have a gold target. The only thing we keep saying about gold is this. Here's the reality. Since it was legalized in the US in 75, at that point it was making a high at $200 an ounce. It had been 35 back in the early 70s in the spot market. And when the future started trading January of 1975, gold had reached 200. Okay. Over the next year and a half, it collapsed 50% down to 103, August 1976. But from that low, August 76, to the 1980 peak, it gained eightfold. If you bought gold at the bare low, you made 8 times your money. Okay. Then after going to 850, you never came back down to 100 again. You came back down into the mid 200s. and you based in the year 2000, 2001, around 260. Okay, so we start from that bear low. From that low over the next 10 years, different period of time, the same dimension move, eightfold gain. Gold went up eightfold times that 260. Okay, went to 1920. Okay. Then we had another bear market that ended in 2015 at 1,050. You do the math. Eightfold says 8,500 or so. Okay. Even JP Morgan recently came out, I think it was a fundamental type report, and came up with an ultimate target of 9,200 or something. But anyway, we're not setting that as a target. The only thing we're explaining to people is, heck, it's done it twice before under far less driven conditions, monetary factors, emergency monetary factors, than what we're going to see and what we are seeing. And it had eightfold moves. So if we do it again, we go to 8,500. And that's just matching what it's already done twice before. So it's almost like, oh, big deal. 8,500. I've done that before, twice. Okay, eightfold gain.
Markets don't crash first. The data collapses after the damage is already done. As Michael Oliver points out here, economic indicators like unemployment and output are lagging signals, meaning by the time the Fed reacts, the market has already repriced risk. The overlooked insight is historical. Gold's past 8x moves didn't require today's extreme debt and monetary conditions, making current comparisons potentially conservative. Investors focusing only on short-term targets miss the structural setup building beneath. If policy panic repeats, capital flows could accelerate far beyond expectations. Next, Michael Oliver talks about why current gold targets may still underestimate the move ahead.
I doubt we'll stop there, but that's just to make a point to investors that, 4,000, 5,000 zone for gold is not some overdone level. It's only half as much as the prior two bull markets. And during that same time, and I think by summer probably, silver will be in the $300 to $500 range.
That's very interesting, Michael. So I think we have to cover mining stocks as well. So, by simply, understanding how mining stocks work, one would assume that, silver miners could be one of the best place to be. But now on the other side, we have the energy situation, oil prices. So how are you looking at this market right now?
Okay. We ran some charts on that a few weeks ago. And what we showed was, if you go back, just take the price of an ounce of gold, you go back to 1980 bull market peak or the 2011 peak or where we are currently, and divide it into an ounce, divide that into, that's the profits for the miners, okay? The negative for the miners are production costs, and energy is a high factor production cost.
A $5,000 gold narrative sounds extreme until you realize it's only half of prior cycle expansions. As Michael Oliver points out here, framing matters. When previous bull markets delivered 8x gains, today's projections may actually be conservative, not speculative. The real overlooked angle is mining leverage. Profits expand non-linearly when prices rise, but investors often ignore cost structures like energy. This creates a disconnect where miners can outperform metals even in volatile environments. For long-term investors, that's where asymmetric upside begins to form. Next, Michael Oliver discusses how energy costs really impact mining profitability.
Okay, well, all of a sudden we see oil going up big, so we think, oh my gosh, their production costs must be killing them. Okay, no. The percent of the price of a barrel of oil divided into gold is like 2% compared to what it was in 1980, it was like 6%. So the production cost measured versus the per ounce of gold is diminished to almost trivial levels historically. So yes, their energy costs are going up, but not in relation to it offsetting their profits per ounce of gold or silver. Okay, so that argument doesn't hold water. And even if you assumed it did, you can go back and look. I think it was 75 to 80 where silver and gold were having a massive move, and oil was having a massive up move too. the same time. So the inverse correlation of oil to profits of miners is not good. Okay, it's a something that the ever bears like to bring up, but it's not a good data point because historically it doesn't fit. And when you do the percent study, it doesn't offset the gains they're making per ounce on the metals.
Yes, I'm very happy you made this point, Michael. So you would expect silver miners to outperform silver during this run?
Possibly, but they certainly outperformed the gold miners. In fact, about 6, 7 months ago, we measured the spread relationship between relative performance between the silver miners and gold miners using SIL ETF versus GDX ETF, dividing one into the other, express it as a percent, plot the chart. It was a clear breakout favoring the silver miners, and they surged relative to the gold miners. In fact, the first quarter of this year, if you look at SIL, how much is it up on the year? End of March versus December close last year. And look at GDX, SIL was up more. Hard to believe, but it was. Okay. We think ongoing now, not only will silver regain a relative value to gold, which is vastly undervalued still right now historically. We're like, silver's like 1.6% of the ounce, divide silver into gold, express it as a percent, an ounce of silver into gold. It's like 1.6% of the price of gold. Well, back in 1980, when silver was still in that old range, 50 bucks, was hit 50 bucks back then. It was like 6.5% of the price of gold.
The energy cost fear narrative sounds logical, but the math quietly dismantles it. As Michael Oliver points out here, oil now represents roughly 2% of gold's value versus 6% in 1980, meaning rising energy prices barely dent miner margins relative to metal price gains. This exposes a common Wall Street misdirection, focusing on input costs while ignoring revenue expansion. More importantly, the SIL versus GDX breakout shows capital rotating toward higher beta plays, signaling institutional positioning ahead of a larger move. Investors chasing headlines miss where money is actually flowing. Next, Michael Oliver unravels why silver's relative valuation could drive the next major surge.
And in 2011, when silver came back up again to 50 bucks for the second time, still in that old range, it was 3.1% the price of gold. We're still half what we were in 2011, and we were 6.5% in 1980. Expect the spread relationship between silver and gold to increase dramatically, and possibly even challenge or even take out those spread highs. Well, that means relative to gold, just to match the 2011 peak, silver could double in value to gold just to reach that. You get the point. And I think that's likely to happen. It's not just monetary factors driving silver, because it is money, and people keep forgetting that. 3,000 years, it's been money like gold. Okay. But it's got the industrial demand is not being met by new supply, period, for the last 4 or 5 years. And there's no gain in that issue. The demand is still outstripping supply. So that's another factor that needs to be built into the pricing of silver, and will be. So it's got dual fuel injectors there, okay, to drive it.
The silver narrative isn't about price. It's about a structural mispricing that's been ignored for over a decade. As Michael Oliver points out here, silver is still trading at roughly half its 2011 relative value to gold, and far below the 6.5% ratio seen in 1980, which signals a major imbalance. What's not being said is that industrial demand, especially from energy and tech sectors, has quietly tightened supply for years without triggering proper repricing. This creates a rare dual driver setup where monetary fear and physical shortage collide. Next, Michael Oliver discusses why silver could outperform even in a broader commodity surge.
And I think it's going to outpace gold. And I think the silver miners, when you look at them historically relative to gold miners, they're vastly cheap as well. And I think they're about to outpace the gold miners. So in my own personal position, yes, I'm watching the mama market gold because it's the key. But It's going to be beat by silver and it's going to be beat by the silver miners.
So, Michael, many people worry about US and the whole global economy going into recession, which they
Yeah.
would believe would be bad for commodities. And then I know that you have a different view, right?
No, they're already cheap. They're cheap, as you said. You want to measure Bloomberg versus the S&P. I mean, it's like what are they going to do? Give it away? It's just ridiculous. And even at current price levels, and right now, by the way, the Bloomberg surge that we saw since October, much of it occurred by January, February, before the war event occurred. So the commodities were coming up before the war, not because of the war. Oil helped, yes, spark it a little bit further, but it was not, it was a general upturn based on cheapness. When central banks print money, it goes somewhere. Investors often choose the stock market, particularly if the stock market is dirt cheap, like it's had a major bear market, like in 2009. It'd gone from 1575 high in 2011 on the S&P, and you went down to 669 or so. Okay, it got cheap. Therefore, when they printed money then, it sort of worked because it was already cheap. Okay, that's not the case now. That argument can be made for commodities. And if you go back, and recession argument everybody likes that. Well, that means silver's going down because the industrial demand will drop and copper's going to go down and all this. No, go back and look at the great global stagflation of the late 70s. Gold and silver were exploding. So were commodities. And yet the world stock markets were dead as they were totally comatose. You couldn't make any money for a decade in the stock market because it was depressed and it still wouldn't go up.
The recession fear trade sounds logical, but history keeps exposing it as incomplete. As Michael Oliver points out here, commodities don't always fall with economic slowdown. During the 1970s stagflation, they surged while equities stagnated for nearly a decade. What's being missed is positioning. Commodities remain historically cheap relative to equities, even after recent gains, which is where capital tends to rotate when liquidity shifts. The Bloomberg index rising before geopolitical shocks suggests this move is structural, not reactive. Investors betting on demand collapse may be ignoring how money actually reallocates. Next, Michael Oliver unravels why commodities could remain the preferred asset class despite economic weakness.
The money flow went into gold and silver and commodities, and despite a global recession. So, and there's other examples of that. So no, that's not a good argument to make against commodities, no.
Right. So, Michael, we covered a lot. Would there be anything else that maybe you would like to mention that you believe is important and we haven't covered yet?
I think if you're an investor, not a trader, not looking for rapid gains quickly, which I think you're going to get in silver and the gold and silver miners, okay, and gold. But the commodity complex is so cheap historically to its own historic levels, to other assets, et cetera. And it's shown to us via long-term momentum technicals that back in October, for example, Bloomberg again was just above 106 to 107 zone. Well, it's pushing around 140 right now, okay? It's a place to be as an investor.
The quiet shift isn't in headlines. It's in where long-term capital is starting to sit. As Michael Oliver points out here, the Bloomberg Commodity Index, moving from roughly 106 to 140 since October, signals early stage momentum, not late cycle exhaustion. What's often overlooked is that institutional money doesn't chase headlines. It moves when relative valuations and long-term technicals align, and commodities still remain historically under-owned. This isn't about quick gains, it's about positioning before broader recognition sets in. For patient investors, that distinction defines outcomes. Next, Michael Oliver talks about where capital could flow next within the commodity space.
You don't need leverage, you don't need call options, but I think the grains, the base metals, another area that got a little bit too hot recently are fertilizer stocks in the ag area. Okay, they got a little hot because of the oil situation, so that may be a little place to look for a break instead. But basically, from an investment category point of view, place to like sort of buy and walk away for 2 years or 3 would be the commodity area in general. And they don't always move with gold and silver, by the way. You can look back and see, well, for example, when gold bottomed in 2015, and by 2020 it doubled, went from 1,050 to over 2,000. During the same time, the Bloomberg Commodity Index continued to erode lower. So they're not always in sync, but I think they've gotten back in sync with gold now, much like they did in the late 70s. And I think it's just a great investment place to be. And I would be more there myself, except that I see silver and the silver miners is the absolute table pounder place to be right now.
The real edge isn't leverage. It's knowing where cycles quietly reset before the crowd arrives. As Michael Oliver points out here, commodities don't move in lockstep with gold. And that divergence between 2015 and 2020 proves how capital rotates unevenly across sectors. What investors often miss is timing within subsectors. Fertilizers, overheating while base metals and grains may offer better entry points shows this isn't a blanket trade. The bigger message is strategic patience. Multi-year positioning beats short-term speculation in early cycles. Next, Michael Oliver discusses why silver miners may dominate even within a strong commodity bull run.
The central bank panics and print more. The problem is it never works. Once those bubbles start to break, it says, that's it. I'm through. I'm going down. I'm going to flush myself. And that money goes elsewhere. Always goes into gold. There may be a brief month here or there where you see gold go down with the stock market, but the major trends are opposite during those times. And therefore, that's the issue you raised, okay, about will their move be over by summer? I think a substantial part of the rapid gain, especially in silver, will be accomplished by then. That doesn't mean they're going to collapse. I think they'll be in a new reality. The old reality for silver was $4 to 50, $4 to 50, $4, back and forth, 50 years of that. Now we've probed into a new reality, even on price. Momentum broke out well before price did. And we're going to seek out a new, more rational reality. And when this stock market breaks, that's going to cause the central banks to panic. And the other reason they're going to panic, and you got to watch this asset, even if you're not in it, T-bonds, long-dated government debt. It's sick. It's a sick market technically.
The real signal isn't gold rising, it's confidence in policy quietly breaking down. As Michael Oliver points out here, central bank intervention historically fails to stop asset deflation once structural cracks appear, and capital inevitably rotates into hard assets like gold. What's rarely acknowledged is the brief correlations like gold dropping with equities are liquidity events, not trend reversals. The bigger story is momentum leading price, suggesting this shift began well before headlines caught up. Investors focusing only on price miss the deeper regime change underway. Next, Michael Oliver discusses why the bond market may be the real trigger behind central bank panic.
You look at a price chart of T-bond futures, go back to 2020, T-bond futures, 30-year bond futures now, we're trading above 190, okay, in price. By 2022, October 2022, they collapsed to 117.5. It's a huge percent collapse, rise in yields. They've not been able to get off the mat since then. Price stays suppressed, yields stay high, and it's choking institutions. And now suddenly, we're starting to hear finally, MSA noticed this back in October, the deterioration in the financial sector, particularly on a relative basis to the stock market, is starting to get some headlines. Not headlines, biggies, not biggies, but get noticed, let me put it that way. Like a Visa card, MasterCard have been plummeting. Certain of the big banks have been dropping, not in a crash way, but dropping in a noticeable way that is what's going on there. Consumer credit is a problem. So the Fed has a real problem. They got their own bond market that's ill, and they got a consumer credit problem. What does that mean? They're going to print, print, print. Gold smiles. That's what gold is. It's money. They destroy paper money, gold goes up. So you got to watch those other markets because they are the drivers. So our assumption is that when silver and gold reach the next level of reality, they're highly likely to stay up there and become, in some cases, institutionalized as money here, there. And as the crisis of the stock market dropping, not in a crash mode, just dropping severely, and the data points going dark, the central banks will print, 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 and that will bring a realization among many that something's not working here. We need something different. And that thought process is already underway. Maybe we need to go back to non-fiat currencies.
The bond market collapse isn't a side story. It's the pressure point policymakers can't control. As Michael Oliver points out here, a drop from 190 to nearly 117 in long-duration bonds since 2020 represents a massive repricing of risk, and yields staying elevated are quietly squeezing institutions and credit systems. What's underreported is how this feeds directly into consumer stress. Credit deterioration and weakening financial stocks are early warning signs. The Fed isn't reacting to stocks. It's reacting to systemic strain beneath them. For investors, and that shifts focus from equities to liquidity conditions,